I did promise I'd yield to Mr Van Manen because he has to go and he has different issues that he wants to pursue. I suspect we will come back to responsible lending later, but in the meantime, Mr Van Manen.
Well, thank you, Chair, and I think that's a very good segue, talking about the risk of unintended consequences from structural change. And I want to go to, I suppose, one of my favourite topics, as you'd well be aware, and that's financial services, but more the advice side of the ledger. In your submission to the Royal Commission on the 7th of May last year, the end of the second round of hearings, you made the observation that the current reforms to financial advice and the cost of financial, or made observations around these topics, the current reforms, financial advice, the cost of advice, and the potential lack of business models that would support the availability of financial advice for everyday Australians. And to quote from your submission, you went, "To some degree this is not surprising, as in other fields, few, if any, genuinely professional services are broadly available to all Australian consumers without government subsidy." My question on this is twofold, and it's interesting to you because in Report 627, which you've recently released, the top two reasons why participants wouldn't take up financial advice was financial advice is too expensive, 35%, and my financial circumstances are too limited for it to be worth getting financial advice, 29%. So 64% of respondents indicated that cost is a direct or substantial factor in not obtaining advice. Now, since the Royal Commission, we've seen a number of large financial advice licensees, and I believe MLC is one. We've also heard from other industry leaders that they will only focus upon the more affluent and not the mass market, which to me is in direct opposition to your stated desires to see financial advice be available for everyday Australians. So I'd be interested in your view on the decline in access to and the affordability of financial advice, and what work are you doing to try and deal with those issues now that they've arisen? Because I know from a multitude of previous discussions we've had, that risk, to be fair, has been somewhat dismissed as not particularly of a great concern.
Well, Mr Van Manen, thank you for that. It is a risk and it is a concern, and I do welcome to the table with me Joanna Bird, who is our Executive Director in charge of wealth management, and amongst other responsibilities, she has oversight of our work in relation to financial advice. I refer back to my opening statement, Mr Van Manen. We are watching two things. We're watching, well, at least two things. We're watching many more, and I'll ask Ms Bird to elaborate on them. But one of them is the structural changes that is taking place in the financial advice space by, amongst other things, the exit by the larger financial institutions in this, and that is something that is that we're very attuned to and we are working on, and Ms Bird will elaborate on that. And the other thing is, of course, the way that financial advice is changing, and that there is, personal advice which is very specific to the individual, and then there's general advice which is broader. So there is a number of different tides that are taking place. There are a number of different inputs that we are attuned to at the Commission level and also at the executive level. And with that, I'll hand to Ms Bird for further elaboration, and Commissioner Press as well, who is also across these issues.
Thank you, Chair. I think the first thing to note is that we are doing a piece of work next year around unfilled advice needs, which is going to take into consideration the changes that we're seeing within the system today, and really looking at what advice do Australians need, when do they need it, and can they actually access it. I think really importantly we're looking at advice in superannuation as well, and I believe that much of the advice that lower income Australians will receive will be through their superannuation fund, and ensuring that that is of the quality that it needs to be.
Does that, is that off the back of your report 614, where you identified that a lot of Australians fail to understand the difference between general advice and personal advice, or is that come from other work that you're doing?
Not off the back of that, but that is a piece of research that we would feed into it. The superannuation funds, both industry and retail, have been providing advice to consumers for a long time. They use and utilise an intra-fund advice safe harbour, but not all of them do that. And we think that it's critical. We're doing a report which will be out this year around the quality of advice in superannuation, because they are very much specific, time-dependent advice considerations.
Mm-hmm. In relation to that, and again back to the cost of advice, it's been brought to my attention that out of report 515, that there's a number of licensees that now have a significant checklist to complete for their advisors, and as to understand what's actually going on. And the copy of the checklist I've been given goes to 20 pages. And I would ask, in the context of that, how, with all the other regulatory requirements presently being foisted on financial advisors, how are you expecting advisors to actually find the time to provide advice when, in addition to a 100-odd page statement of advice and any other number of pieces of documentation they have to currently do, they now also have to do a 20-page checklist to verify that they're covering their bases?
So 515 relates specifically to the big banks. Mm-hmm. I don't think there is anything in that document that specifically says they must have 20 pages worth of compliance checklists, and that is a decision being made by the licensee on the advisor. I think that the way the banks have addressed and looked at 515 has created some interesting responses, but it does not mean that that advisors cannot give advice to consumers, and we're continuing to see that. So I'm not sure where the 20 pages of compliance is coming from, but it's not directly required within our guidance.
Well, I think it goes back to the discussion we're having around responsible lending. All I'm seeing at the moment from all of this regulatory activity is an ever-increasing burden of regulation, red tape, documentation that is only doing two things. It's making it more difficult for consumers to get, in this case, advice in a cost-effective way, and I'm not entirely convinced it's improving the outcomes for consumers. So I'd be interested to know what work you are doing to have a look at what the impact of the regulatory burden on the sector is, and by extension, what the impact on consumers is in having a reduced access to or a more costly access to services that they require.
So the report that I referred to earlier around unfilled advice needs, will consider those things. Mm-hmm. And very importantly, we're looking at not can every Australian access financial advice, but can Australians that need financial advice and want financial advice access financial advice. And that is a slightly different question.
And Mr. Van Manen, you raise the question, I think, also in a broader context, which is just about performance and measurement and effectiveness. I want to be absolutely clear. We don't want form over substance responses. We want substantive improvements. And if the outcome of an intervention, an outcome of one of our decisions is form, not substance, then that's the feedback that we want to hear. I also mentioned, as did the Chair, about developing metrics and performance measurements around the effectiveness of our activities and actions. And this is something that we want to develop over time and work with you as the committee, because again, we want the outcome. The outcome and the intent is more professional financial advice. That's what we want. Our outcome, our KPI, is not more forms to fill. And if, to the extent that we can measure and look towards measurements and feedback as to whether or not that outcome of more professional advice being given is what we want to hear. So you have my assurance that the issue that you raise, that I'm very attuned to, and that's why performance measurements, outcome measurements is very important.
So on that note, and I don't disagree with you, I want to see a professional financial services industry that provides high quality advice to Australians that need it. I have no argument with that proposition at all. I do, however, have an issue with the proposition, and I recognise that a piece of legislation in relation to this has already gone through this Parliament, but it's about the order of work in relation to this particular piece, and I refer specifically to the issue of grandfathered commissions. Now, in your submission to the Royal Commission, you state, and it's paragraph 11 on page 3, you state that ASIC is concerned that it's almost 5 years after the implementation of the FAFA reforms, grandfathered commissions continue to form a significant proportion of licensee and advisor remuneration, and grandfathered commissions operate to incentivise advisors to keep clients in legacy products with a continuing commission structure even where there may be better products available to meet the client's needs. And then paragraph 12, accordingly, ASIC believes that the grandfathering of commissions should cease as soon as reasonably practicable and to the maximum possible extent, although it accepts that consideration may need to be given to a short transition period to allow licensees and advisors to adjust their businesses. Now, what I find fascinating and troubling in relation to this, so that was, I believe, in about June of last year, you issue a press release on the 21st of August this year to say that ASIC is investigating the progress of transition away from grandfathered conflicted remuneration arrangements, but it's quite clear from the remainder of that press release and the work that you haven't done the work to actually understand what level of grandfathered commissions are in the system, what level of revenue is being paid to advisors, and you actually, at this stage, appear to have no idea of the impact on your comments in your submission on the industry.
So that press release was in response to a direction from the Treasurer that we investigate and identify and ensure that this occurs. We are seeking to get information back from industry as to what the baseline of commission is today.
But sorry to cut you off, but surely you should have done this work prior to making these statements in your submission to the Royal Commission.
So, Mr Van Manen, we had done earlier work which wasn't as comprehensive as the work we're doing now, where we looked at samples to see how much grandfathered commission existed in the system and found really huge variations across licensees, and they were just samples. We'd also seen, we do a lot of monitoring and supervision of advisors, and we'd seen circumstances where we thought that grandfathered commissions were having a negative impact. The press release that you're referring to now is not trying to suggest that we've never done this work before, but it was saying that we're now doing this in an extremely comprehensive manner because we've received a direction from under Section 14 of the ASIC Act from the government or from the Treasurer to actually do this work and see how across the industry commissions are being reduced over time and the extent to which they're being rebated to consumers.
Right,
But
so
that
can-
wasn't to suggest that we had no data prior to that.
All right, so can I put a couple of questions to you, and I'm happy for you to take them on notice because there's a range of them. What is the total amount of invested funds in the products that are subject to grandfathered commissions? How many product providers and how many financial advisors are impacted? What is the total amount of annual payments of grandfathered commissions? What is the total amount of annual payments of volume bonuses and shelf space fees? To what extent does this include payments with respect to life insurance and annuities? Because there are a range of products in the system that are not rebatable for a variety of reasons. How many of these clients are in products where the advisor service fee functionality is currently available, or where that service fee, if it's available, can or cannot be turned off? What, if any, consideration has been given to the impact on clients whose products can't be moved due to a range of factors, but not limited to exit fees, capital gains tax, Centrelink grandfathering arrangements, insurance, etc.? And what, if any, impact will there be on those clients in relation to their personal situation as a result of grandfathered commissions having to be rebated to those clients in terms of their maybe Centrelink situation, etc.
So, Mr. Van Manen, I'll take that on notice because I think that's the sort of exactly the sort of data that we'll get out of our work, which has a qualitative and quantitative component. But while you were going through that, I also recalled, of course, that the Productivity Commission did also produce a lot of data about the extent of grandfathered commissions as well. And so I just wanted to reassure you that the statements that we made in relation to the Royal Commission were not based on a sort of vacuum of data. It's just that the data we're gathering now is comprehensive. And in fact, the data we're gathering now, we have been asked specifically to gather for a period of 18 months, and that's what we're doing. I don't know.
So maybe to supplement Mr. Van Manen, so the first time any estimate was ever made with respect to trailing commissions was by the Productivity Commission last year, and the reason that no estimate had been made prior to that because regulators, and in particular APRA, had not collected that data. So in the superannuation sector, for the first time it was identified that there were 630,000 member accounts that had trailing commissions with respect to financial advice attached to them.
But that doesn't mean that they were grandfathered. They might be current arrangements.
So they would have to have been grandfathered because they couldn't have been paid otherwise.
That's right. And I can't remember the actual estimate. I couldn't find it quickly enough, even with the help of Mr. Google and Commissioner Price. But I do recall that it was hundreds of millions of dollars, and it was those estimates and calculations that Commissioner Hayne relied upon in the Royal Commission report, which then informed the follow-on work that ASIC is doing.
So how many of those would be small balance accounts that now, as a result of the passage of, or inactive accounts that are, as a result of recent passage of laws, will now get consolidated under the new provisions to consolidate members' accounts where they're inactive for a period of time?
So a lot of these, Mr. Van Manen, were in the choice segment. A lot of the inactive accounts are actually in the default segment. So I don't know the specific answer to your question, but that might be helpful as a partial answer.
Okay.
Just following on from Mr. Van Manen's questions, which were quite prescriptive, a broader question, going on from that with the grandfathering of the trail commissions that the life insurance industry, banks that sell life products, superannuation products. In many cases, those fees that are paid to the financial planner or to their, let's call them an agent, is taken up front from the premium. Many people who pay yearly, many people pay their superannuation or their life insurance yearly. That money then is given in dribs and drabs as a trail commission to the advisor. If and when changes are made and we phase away from trail commissions, will that money then go back to the consumer who has paid for it? Or will it remain with the banks, the financial institutions? Because there would be millions and millions in those accounts, money that's been taken up front to pay the advisor that small trail fee or service fee to service the client.
The legislation directs at them. So there's sort of two sets of commissions we're talking about here. We're talking about grandfathered product commissions, which they've been banned under FOFA, and the only ones that can still be paid at the moment are ones that are grandfathered. And then there's life insurance commissions, which are still permissible, actually. So they're not grandfathered, but there are trail commissions associated with them. So the banning, the grandfathering thing only relates to the product commissions, and those, the legislation provides that the benefit of that ending of grandfathering is to pass on to the consumers. So it's supposed to be rebated to the consumers. And one of the things that ASIC has been asked to see is what happens in that 18 months leading up to the implementation of that legislation, and how, if product issuers are ending those commissions, where is the benefit of that commission going to? So that's another thing that we will be trying to track, and we'll report to the Treasurer in the report we give to him as directed.
To follow on from Mr. Georgianus' question, which is perfectly valid. Right? For example, if somebody has a guaranteed lifetime annuity that was taken out in 2001-2, which is quite likely. A couple of issues with that. Firstly, that particular annuity will be asset test exempt, because that was before the asset test changes were made in 2004 or 5, thereabouts. It's a guaranteed lifetime annuity that payment's going to be paid for that person's lifetime. As it is a fixed payment, which is set, some might be indexed. How is that, because that's already been all calculated into the annuity that's being paid, how is that rebate going to occur? On what basis is that rebate going to occur to the consumer? And does that materially change the nature of the annuity contract? And does that put at risk the fact that that annuity contract is no longer asset test exempt? Is that rebate of that income become assessable income for them under Centrelink? There's a whole range of questions here that nobody has thought through and nobody has considered. Now, I don't particularly have an issue with the fact that grandfathered commissions are being done away with. I'm just concerned that the totality of the risk and the consequence, and goes back to the Chair's opening remarks about the economic impact on clients involved, has not been fully thought through. And the fact that that work hasn't been done prior to you making the comments in your submission to the Royal Commission, which has subsequently informed legislative decisions made in this place, I find disappointing and frustrating in the least.
So we've discussed those complexities undoubtedly exist, and the product issuers and the advisors have been raising them with us, and we have been discussing them with the Treasury as they settle the legislation and the regulations that will be made under them. And it's for that reason also that our review has a sort of a qualitative part where we intend to speak to the product issuers about all those sorts of practical difficulties and try and help them solve them and report those to the government as well. Because you're right, it's a complex situation. Whilst the principle is, as you say, right, there will be complexities around the edges as we try to implement it, and we want to work with industry to make that work.
So can I ask then why in your submission to the Royal Commission, you as the regulator didn't identify those complexities in your submission as a flag to the risks that will be raised as a result of getting rid of those grandfathered commissions.
And in fact, all you said was what might be needed was a short transition period. Which
And to the extent possible, which should be ended as soon as possible. And I think, as you said, we still agree that the principle is correct, and we think these practical problems that you've highlighted are problems that can be solved.
But my point is that your response to the Royal Commission is not fulsome in identifying the issues that will be raised as a result of pursuing this avenue.
Mr. Van Manen, I remember that paragraph very well, and that paragraph I remember being drafted with an open mind, hence the words that have been highlighted by my colleague Ms Bird, which was to provide an allowance and flexibility for the consequences and the complexities. So, yes, you're right. That submission to the Royal Commission was a very lengthy one, and there are a number of other issues involved. And whilst we did not elaborate on some of the issues that you raise now, we were certainly mindful, hence the careful language used, that there are complexities, and that's why right now, as my colleagues were mentioning, we are actively engaged with the industry, actively engaged with Treasury to try and work those issues through. And I would invite the industry to continue their engagement with us to highlight these areas of concern.
So wouldn't it have been more prudent to say a transition period rather than a short transition period if you are already well aware of some of the complexities involved?
I'm actually reliably informed that we actually hit the page limit on that submission because we were mandated by the Commissioner as to the levels of pages that we could submit. Subject to further ability to have further submissions, which unfortunately we weren't, and given that the request and guidance is to brevity, that may explain why the language is what it is. But look,
can I take that a step further then?
Just quickly, Mr. Van Manen, we're right on our scheduled break.
In an earlier response, it was mentioned that you were talking to Treasury and to the government about more of the detail in this. Can I safely assume, which is always dangerous to assume things, but that in your discussions with Treasury and the government about the regulations to enact the legislation, you are having a more detailed discussion about these risks and these issues that are being identified and are being brought to your attention by industry and others?
Yes.
and they are significant.
Mr Van Manen, perhaps a further supplement that might be helpful. Two Productivity Commission reports that were also out in the public domain, a draft and a final on the financial system and superannuation, did highlight some of the practical difficulties in implementing these changes to grandfathered commissions, and ASIC was aware of those, and indeed so was the Royal Commission. So some of the issues that you've raised, not all of them, but some of them, had already been flagged and had been an input to the Royal Commission.
Okay, on that note, I think the committee will suspend for lunch, and we're returning at 1 p.m. Thank you.
Thank you.